As far as JLR is concerned, the UK remains a challenging market. We have called that out explicitly. At the same time, we shouldn't forget the China market continues to do very well for us, and rest of the world continues to do pretty well for us. Europe, from a situation of red, we have now moved it to an amber because we are starting to see growth coming through. And at the same time, US continues to remain challenging from the point of view of its traditional cyclicality that is there. As far as our growth plan remains, we specifically called it out in our investor deck where we said that new models will continue to come through well. Keep in mind that we launched 5 models last year, and all of them are going to get their full year impact this year. I-Pace gets launched in July. So the product pipeline is coming through very strong, and we are very excited with the product pipeline. That for me is the starting point of growth, and of course we need to be clear, given our market shares, there is definitely opportunities of growth to remain there. Hence we have explicitly called out that we expect, as far as FY19 is concerned, both growth and profitability to be better than FY18.
So when you say better, give me some sort of hint. Will it be in high single digits? Will it even get to double digits in terms of volume growth?
I think we don't look at the individual number per se. The fact that we are growing is the key point, and we have to be better than last year. And of course, we know what our capability has. If you go back in history, kind of capability, what is the possibility that we can deliver. So I think we are quite confident with the product pipeline that we have, and therefore we look forward to a pretty exciting 19.
All right, you have given an explicit guidance for the EBIT margins. You've said about 4 to 7% for FY19 to 21. I want to understand that given that the volume upside is capped because of challenging conditions, is there any major cost-cutting cost-cutting program that the company plans to do in order to achieve these margins?
See, more than a guidance, I'll call this a plan that we're internally planning for. And the reason we have did that is that people who are keen to understand, as we put out an 8 to 10% guidance before, how are we intending to reach the 8 to 10% broad range that we had indicated? Yeah. If you adjust for the capitalization policy changes that you've done, 8 to 10% becomes 7 to 9%. That's a 100 bips correction that is there. And therefore we said over the next 3 years, we gradually will improve from where we are today, which we are not comfortable with what was there last year, to a 4 to 7% range and step it up in that direction and then take it off from there. To do so, I think multiple levers are there. Innovation and growth is an important lever. We are not going to let that go. That's the reason we are continuing to invest. As far as other areas are concerned, we will continue to drive improvements in contribution margin and mix, very, very key part of any portfolio. And of course, fixed cost, if you look at the last 3 years performance of JLR, while we did better on most counts, we get almost about a 6% CAGR till FY17. The area where we lost out is operating leverage. And this operating leverage is basically not just depreciation and amortization coming down only because of that, but also a fixed cost, which is cost of vehicle, what is the cost per vehicle made. Those costs have increased compared to what they were before. So therefore that is an area we need to take charge of and bring it down, and so that we can able to drive operating leverage. You've seen that happen in Tata Motors story, where the standalone business has actually delivered tremendous operating leverage. So we would want to see how we can replicate parts of that in JLR as well.
I'm going to come to the standalone business in a bit, but before that, as we see more and more electric vehicles come on board, electrification of vehicles is generally a low margin business, but you still have your longer term margin guidance, which is higher than the short term guidance. You don't see electrification impact your margins?
See, that's a mix of portfolios that you would have, and in the peak of electrification, what is the percentage of your portfolio likely to become electric, we need to think about. So the mainstay will continue to remain the IC engines and plug-in hybrids, which are all extremely profitable businesses. Land Rover is an extremely profitable business there. I think we have to ensure that we are leveraging those core assets as we go forward. And of course, volume leverage. The biggest thing is not a contribution margin issue. JLR does not have a contribution margin issue, which I have in the passenger vehicles business in India. JLR has an operating leverage issue. Operating leverage issue is an element of discipline, focus, cost control. Get that right. A business of a 25 billion pound business with a 1.5 billion pound profit, if you get your cost structures right, you will make money. So we are quite confident of getting that number of 4 to 7%. Which is the reason we put it out there.
It's good you mentioned that, because the margins, if you look at the EBITDA margins for JLR, they've come up substantially to 10% by the end of FY18. Back in the day, about 4-5 years back, you were doing almost 17-18%. So is it safe to assume that because of all these cost-cutting initiatives, etc., you will get back to the high teens?
That's the only way we'll deliver 4 to 7% EBIT. Therefore, EBITDA has to improve by the same 300 odd bips that you're talking about in this period. Back to where it is supposed to belong.
Okay, that's good to hear. Talking a little bit about the domestic business, of course the standalone business continues to be under pressure. This time we've seen the margins come in at about 7.5%. Even if you make the adjustments, it's about 8.5% or so, less than what you've done in the past. This despite the medium and heavy commercial vehicle segment being on an upcycle. So is it purely the passenger vehicle segment which is becoming a drag, and will that continue?
Okay, I think as far as the domestic business is concerned, this year we have turned PBT positive if you adjust for the one-offs that we have taken. For the quarter, we are actually screamingly PBT positive. Yeah, we are cash positive after 5 years, which means you should be clear that it is only a one-off impairment charge that is making the number, because there is real cash coming through. This quarter we made 2,000 crores of cash. So everything is going right as far as that business is concerned. The passenger vehicle, if I split the problem into two, there's a commercial vehicle business where I think we are now really starting to put gaps between us and competition, because earlier part of the year we are more into filling up portfolio gaps, which we had a lot. Now we are starting to get that piece right. There is one of the things that people tell me is that there's huge discounting happening in the M&HCV sector. I'm sure you're going to ask that. And we look at it and smile and say, yeah, but my variable margins, which marketing expenses, is significantly lower this year compared to last year. So where is the discounting that people are talking about? I don't get it.
No, in fact, your peers like Ashok Leyland have spoken about discounting gone down in this quarter versus last quarter on a quarter-on-quarter basis.
Absolutely. For me, discounting is lower this year. My VME is lower this year in M&HCV compared to last year. So it can be as categorical as that. Yeah.
Okay.
So therefore, the margin improvement in CV is significant as far as this year is concerned once turnaround got called out. At the same time, passenger vehicles is now starting to sequentially improve its contribution margins, because better mixes are coming into the market. Cars are better margins, and better well received by consumers, which is the reason now we have picked up shares 2 years in a row, and I've exited at 6.8 share. Definitely not where we are satisfied with, both in CV and in PV. Shares have to be much higher than where they are today.
So what are you working with as an internal target for passenger vehicle market share?
The vision that we have put out is we should be a very strong number 3 player, which I think is within the realm of achievability. So therefore we said, let's first get to that, because before you summit the mountain, you first have to hit base camp. So base camp for passenger vehicles is, let's get to a strong number 3 player.
Okay.
And in number 3 player, we also have to start making profits, because it's a business that is not yet profitable.
Yes.
But we are very clear, the reason why we have called it Win Sustainably is that we have to get to profitability as well in a sensible time frame.
So by when do you think you could get to profitability?
As soon as possible.
Any kind of timeline? I mean, FY19, FY20?
It starts with first switching on to your mind that this is the way we want to operate. Then timing is a matter of it just happens. I think the fact that we called out turnaround 1, which was last year, I think nobody expected us to turn around this fast with this intensity, which we have done. We have picked up share, we have picked up profitability, we have delivered cash. I think that for me is a call for a turnaround. It's a clear turnaround that is there. And we have picked up share both in CV and in PV. There is never, and these are multi-year share losses that have been stemmed and turned around. And thereafter we have delivered cash, we have delivered profit. So I think we've got a very good story that is there. But he said, no, we are not going to be satisfied with this. We want to now really embed this deep in the organization and give a purpose for each of these businesses. So CV is very clear, win decisively. PV is very clear, win sustainably. And the third ambit of turnaround 2 is embed turnaround thinking in everything that you do in the organization.
What part of the upcycle are we in the commercial vehicle sector?
We believe we have started, as far as the upcycle is concerned, this year is the first start of the cycle. And we expect to see that go forward, given the investment that is happening in infrastructure, the GDP growth that we see, loading restrictions that we see.
So there was a 20% plus volume growth last year for MHCVs. Is that something that you think you could do this year as well?
I think we are quite happy with the kind of progression, the demand that is currently underway. If I were look at what is the fly in the ointment that is likely, there are 2 things that we look at it and say that's a bit worrying. One is the price of fuel that's increasing, and therefore inflation coming through with that, number 1. And number 2 is because of that interest rates, because CV and these are automobile industry as such is highly interest sensitive. So therefore if it really explodes, a little bit interest rate rises we are not too worried about, but if the interest rates were to suddenly take off for whatever reason, geopolitical a trade deficit, whatever could be the reason where there's a significant inflation and interest rate corrections, that could be a cause for concern. But having balanced the demand but I don't want to sound alarmist. Having seen the demand situation and this, I think we are more on the optimistic side at this point in time.
These hard decisions you're taking on the accounting policies, etc. I notice a lot of that has happened once the new chairman has come on board as well. He seems to be taking a lot of interest in the decisions. What is his vision in terms of the long-term plan for JLR? Any plans to hive off the business? People have been talking about an IPO. If you do get a strategic investor, do you plan to get them on board?
So I think independent of whatever be the capital structure we want to operate with for JLR, I think that's for me is the least of the issues that we have. I think the starting point which you put out explicitly is that there are 6 cylinders in the Tata Motors engine. There is JLR, there is CJLR, there is CV, there is PV, there is Tata Motors Finance, and the 6th one, which is all other subsidiaries and my net debt situation. These 6 cylinders on their own need to be consistent, competitive and cash accretive for TML as a group to really fly. That is what the strategy from the chairman, and therefore he is taking enormous interest as far as Tata Motors is concerned, which we are very thankful for. A lot of guidance, and therefore that's also getting us very fast in terms of decision making. Look at the number of decisions that we have put through in a very, very short period of time. Starting from turnaround 1, we then moved on to changing the accounting policy, we then moved on to deciding on our subsidiaries, what decisions to be taken. We have put in an ESOP for our employees in Tata Motors. Now this kind of speed of decision making, I'm sure you would never have seen us operate at this speed before, but that's exactly what we are able to do because we're now pulling together as one Tata Motors group.